Good morning, it's Frugal here. As always, I have my coffee because otherwise somebody might just get killed. So let's talk today about tax, different types of tax, and how does the tax system work in South Africa. Note that this is an overview video, this is not an in-depth video, and there are lots of other channels that you can check if you're looking for more in-depth answers to your questions. So what is tax and how does it work? So think of it as a collective scheme, right? So what needs to happen, like a company, things need to happen, right? You need to build infrastructure, you need to build certain things, you need to build, if it's your company, you need computers, you need admin to be done, and somebody needs to fund this. So you just can't go, and go like, here is the money, here it is. You sort of need to fund it from somewhere. Now, the government and governments across the world fund this through either one of three things: bonds, taxes, or investments. Now, in some cases, governments, such as more in the Middle East, what they do is they fund that through investments in oil. So as the government produces oil, they basically export that and they get lots of money for that. That is how they fund things like infrastructure and keep taxes low. In other countries, what they do is in South Africa as well, to a certain extent, they can say, listen, give us your money, we'll give you some interest, and that's basically bonds. And the one that most countries do, almost all of them, is tax. Now, in tax, what they do is they look for taxable events, things that are happening, right? And when they happen, they say, okay, this has happened, you need to pay tax on it. A couple of taxable events that you might find would be, number one is when you get income, okay? So that would be employment. So you are employed and you get income. Another one would be if you sell an investment. So you basically get income through an investment. Another one would be that if you get a share of profit. So that would be something like dividends. Another one that you might get would be something like a turnover on money that's going in and out of your company. That would be something like turnover tax of a company, and something like dividends, where you get a share of the profit. So there could be different things, and in South Africa, tax law is extremely complicated, but I do want to just touch on a couple of them so that we can understand a little bit more about how they work and what happens. So, for example, when it comes to income tax, right, it means that you are getting money in. So you are getting money that you can then use to buy things, right? So that would be for food, clothes, all of those things, place to live, all of those. And you basically say, well, the government says you need to pay tax on that. So as if you are full-time employed, it means that you will need to pay as you earn. So there is certain tax breaks and certain thresholds, which means if you're earning less than a certain amount, you will obviously get, not get taxed on the first X amount. So concerning the other things, what you get, for people earning a lot more money, so for less money, you pay less tax, which might be about 18%, right through to the higher end people, which are earning a small fortune, they're paying 45% for their money, their income that they get. This is what gross and net often refers to. So what you'll find is that there will be deductions, which include tax. So you'll get gross, which is everything, and net, which is after deductions and tax. So there might be other deductions which are not necessarily tax, but the biggest chunk of it generally is tax. That's why you'll find that sometimes your boss will tell you, I've given you a 1,000 Rand raise, and it pushes you into the next tax bracket, and you're actually getting out a lot less than what you did previously. So you need to monitor that. You need to know what tax bracket you are. You can check on the SARS website for that. It is floating around the internet as well, but I prefer, the legal route and the legal paperwork to say that this is your tax bracket. On the other hand, income that you might get as income would be something like you working for yourself. You are a freelancer, you are self-employed, you run a business. So, concerning the money that you get in as your personal income, you need to deduct all expenses. So that would be something like petrol to the client, as well as, if you need a computer to do your work, if you need internet to do your work, all of those things are, you can deduct from tax. And you should. If you are full-time employed and you need to go into an office, then generally you can't deduct petrol to and from the office. It's just the way that it works. So, but if you have multiple clients and you need to drive to them and you need to do certain things, or you are a contractor, you do have a lot more things you can deduct from tax, and then only the income that is left is tax deductible, which means you pay less tax, right? So, also what you get is you get tax on investments and company tax. Now let's touch on company tax first. Company tax, we're looking at around about 28%, depending on which tax year we're in currently. And what that basically means is that on all profits, you need to pay tax. Now, there are a lot of tax breaks that people use, that people can say, listen, I'm using this and this and this tax break, and I don't, and they get discounts on the amount of tax that they pay. And when you get to that point, you go and speak to a tax expert. And many companies do that, and they lower the tax that they pay, they reinvest it, they buy assets, they do certain things like that, and they basically don't have to pay tax on everything, which is quite cool. But I do warn you that if you are going that route, make sure you get legal advice, tax advice from somebody who is an expert. You do not want to get it from somebody on the street that just says, oh my goodness, you can do this and that and the other. Now, you also get tax on investments. Now, investment tax, on the other hand, what you find is that they say, okay, the company, let's say you buy shares in a company, the company's made profit. The company first needs to pay that 28% tax, which is the company tax. And the second thing, when they make profit, they want to give you the shareholder money, you're going to pay dividends tax or dividend withholding tax. Now, in South Africa, that is 20%. Now, if you invest in something like an ETF that has overseas exposure, if we have a tax agreement with that country, we might, in the case of the US, we pay half of the dividends tax on the US side and half on the South African side. So you will be paying tax, because there's three things you can never get away from: death, taxes, and sure. You can never get away from sure, right? So if you invest in property, you are going to have to pay tax on that. For rental income, it is currently on your normal tax rate, which would be your pay-as-you-earn tax rate. If you're in the 45% tax bracket, you're going to pay 45% on all income earned. If you are going to sell your property or sell your stocks after a long period of time, then you are going to have to pay tax on that. That is capital gains tax. Now, capital gains tax, they've got complex formulas to work that out. You can check some of the other videos online as well on how that is worked out. But generally, you can say it wouldn't be more than 18% of your profits. They've got this funky formula where they say the first 40% is tax-free, and then 40% of what is left, 40,000, the first 40,000 is tax-free, and then 40% of what is left is then taxable at your normal tax rate. So, but it just goes and it changes, and it's just weird. So when you get to that point, you can, check with your tax advisor as well. So when it comes to capital gains tax, it means that you've invested for the long run and you're selling an asset, which might be stocks, it might be a company, it might be property, a rental property or things like that, that you have to pay tax on them. So remember, if you do it in the short term and you're day trading, then it is seen as normal income, and your pay as you earn income will then be, you're going to have to pay just normal pay as you earn. So there's obviously other taxes as well. There's VAT for companies. If your turnover is more than $1 million and you're not registered just for turnover tax, you need to pay VAT, value added tax. So generally how that works is that the last person in the food chain needs to pay the VAT. For people upstream, they can claim their VAT back, which is quite cool. So if you're the end user, you pay VAT. So for example, in your, on your coffee that you buy at the coffee shop, your food that you buy, you're going to have to pay VAT on that. But you don't see that because it's generally included in the price. The South African standard is that tax and VAT is always included in the price, and sometimes people do exclude and say just it's this excluding tax, excluding VAT. And the reason is because some of those industries, they know that you're not the end consumer, so they do exclude it, and they're very outright that they do exclude it. If it doesn't say it is excluded, you can confirm that it is included generally. So then what you get is you get tax that you pay when you die. So generally the first couple of million, you don't have to pay tax on your estate, but you still have estate duties and other fees that you're going to have to pay on the gross of your estate. So you do need to make sure that if you have a fairly large estate, that you speak to a very good estate planner, because that fees can go really high. And if it's over 30 million, then you're going to pay 25% tax pay on your estate, which you sort of don't want to do. It's a lot of money. I really do recommend then speaking to an expert in that field. So that's a little bit about tax in South Africa and a couple of the biggest and most important taxes that you need to be aware of. Yes, there's more taxes. Yes, there's other things that you need to know, other funky things that you might think like, what the hell is this? But it's good that you are aware of those. Now that you know a little bit more about tax, have a wonderful day and happy investing.